All right. Well, we got another one, episode 35 of our sneak peek for the week, and there's a lot to talk about. And a lot of it has to do with what's going on in the market. So I'm going to jump right in as always. We're going to talk about four things today. We're going to start on falling knives and the idea of dollar cost averaging as a mistake during times like these. We're going to talk about some economic indicators we're expecting. We're going to talk about earnings. And then if you stay till the end, we're going to get into the idea of tax loss harvesting. Tax loss harvesting without my accent in there. And this is really, really important because there's a lot of rules and regulations around how you can do this and how it's going to affect your portfolio, but also doing it in a way where you're not going to get caught up in wash sales. So effectively, you don't want to do it and then have it be worth nothing when the time comes and get hit up on your taxes for this as well. And then before I start, a word of warning. There's a lot of really new investors and traders who are in the markets. And when the markets have been so good the past couple of years, people are making gains, especially really this past year. People are making gains across crypto, across equities, just in general. And I think that what I'm hearing from a lot of folks is they're not really aware of the fact they're going to have to pay taxes on capital gains in the fact that it's short-term capital gains. So please, please, please take a second. And even if you're not going to watch the whole thing tonight because you're not interested in indicators or earnings, which I hope you are, but if you're not, at least get towards the end of the video and let's understand tax loss harvesting, because as we're coming up in the end of the year here, it's really important that you understand why you want to sometimes dump those losers now, shift into something different, take advantage of losses in the market while you have them before you sort of sit on those gains and have to pay taxes on it. As always, I'm going to start this off a little bit differently. We're going to talk a little bit about some tax issues. Please, please, of all the things people should be getting help on, when it comes to taxes, absolutely try to get help from a professional. It's worth its weight in gold if you are saving money that you wouldn't otherwise be putting out. There's real cash savings typically when it comes to investing in taxes. So with that said, I am certainly 100% not qualified to be an accountant. I am not a CPA. I'm not offering tax advice, but you need tax advice when it comes to your short-term and long-term gains, depending on how much you have. So with that said, let's pop right in, right? So let's talk about this idea of a falling knife, because what we've seen in the past week here is the markets have really started to come down, and they've come down fast. Some asset classes and some sectors of the market are doing much worse than others. And what happens is there's this very key term called catching a falling knife, and it's especially damaging for newer investors who haven't seen markets like this, are not familiar with the way things will bounce and create fake bounces, or what we call as a dead cat bounce, where you think it bottomed out and started to rise up, but it's going to fall down again. So real quick here, a falling knife is essentially just a sharp drop. It's not that we necessarily put parameters around how big of a drop or how long of a drop, but it's just a very sharp, sudden drop when the market feels like it goes straight down. We saw it with a number of tech stocks this week. As of the recording of this, a lot of cryptos have really crashed down very fast, actually, and it's almost stunning because it's hard to really see a connection as to why this is. There's lots of reasons, but sharp drops without reason are always going to be concerning. And the other problem with falling knives is they can quickly respond back up in what we would call a whipsaw. And I talk about whipsaws a lot, where the market's volatility tends to be all over the place. But the issue is if you're trying to buy on the way down because you think you found a bottom, you can suffer a lot of pain. And especially nowadays, what we're seeing is more and more investors are trading on margin without necessarily having been through these markets, understanding the repercussions, how margin can change, how the necessary underwriting of those margins can affect your portfolio. So if you're not familiar with this concept of these sharp drops and how fast or how long or how deep they can go, do some historical research on previous deep, sharp market changes to see how long it takes for them to come back up, because it isn't always as obvious as you may think. Now, the other piece of this as well is if you're a little bit more experienced and you're looking at the market from last week where things really fell off sharply, this is a great opportunity to look at what maybe wasn't affected or where you think there's strength or where you have some solid technical analysis telling you that this is wrong and this was a mistake in the market. It's an overreaction. It could be related to more of the COVID issues that are going on. It could be things coming out of the Fed. But know your move before you make it and research it, right? This is a great time to think about playing a put against something that has more room to go down, but protecting yourself on the upside, right? This is where things like straddles can get really interesting. But again, and I hate to do this all the time, a word of caution, straddles, which is when you play both a put and a call, pay the premiums for both and try to look for a significant move in either up or down to catch that upside or downside profit that's going to overtake your premium. The key here again is if things go down, but then you don't get a big enough move, now you just paid out that premium for no reason. And additionally, straddles have been getting very expensive from what I've seen. So really what I wanted to walk away with was, if you're relatively new to the markets and you haven't seen these kind of drop-offs or rapid sell downs, it's okay to take a breather. It's okay to not be right. It's okay to miss the bottom. In fact, frankly, very few people catch these things at the bottoms or the tops. And the reality is, when they start to shift gears, it's usually because of large scale institutional investing to either start buying or selling again. And that's going to be the real kickoff. So if you miss the bottom by a little bit, that's okay. And the reason I included the idea of dollar cost averaging as part of catching the falling knife is, if you're trying to think about things over the long term, retirement, building a portfolio, getting those stocks you paid a lot for maybe in the past couple of months to bring those average prices down, this is an easy way just to have a relaxing approach to this and say, look, I really believe in this. It's a long-term holding for my portfolio. You don't need to worry about the bottoms. You don't need to worry about how far and how low it can go. But if you're on margin and you're looking at these sharp drops, please be aware that you can get wiped out very, very quickly. And oftentimes what happens is we wipe out lots of these margins. You get the call and have to sell your stock. And that's when you see things start to come back around. So don't be the cause for other people to make a lot of money when the markets turn around because you lost yours because it was on margin. So always be aware of where you stand. Always make sure you have plenty of breathing room for any kind of event that can happen. Now, let's start talking about what really is happening, because I think there's a lot coming in this upcoming week here that we need to really, really have our eyes on that could either help to significantly push this market back up or potentially keep it where it is or even push it down further. So the biggest thing I want to talk about, as always, is the November consumer, the November Consumer Price Index. So what we're looking for an update on is really going to be across two things. We need more data, frankly, on what is going on from the Omicron variant as it relates to COVID-19. And we're going to see how this impacts us from an inflation perspective. Not that Omicron is affecting inflation, but really the impact of that as a force multiplier on top of what we're seeing for inflation. I think that what we're seeing sort of worldwide right now is a continuous, I think, somewhat overreaction to news or a reaction to no data whatsoever. And this is what's causing these whipsawing effects of things shooting up and then crashing back down. We're seeing false bottoms, we're seeing false tops. It's getting very hard to pick points. And this is why, if you're not very experienced, and I'm going to bring this back again, stay away from margin or don't trade until the markets settle in a little bit if you're not really sure which way to go with it. And so I think the reason we're speaking about this is, much like the inflation news, the variant news seems to be just as all over the map. Every time we feel like we get our arms around one thing, a new thing comes through, a new version of it, a new variant, a new country being affected. And then, as it always seems to happen, it doesn't get contained. It starts to spread. Then we find out how serious it is, yada, yada, yada. And then all of a sudden, it's a question of efficacy and what the companies are doing to get, some sort of backstop against any further infections or further damage from it. Now, the other thing to really keep in mind is we're dealing with yet another variant of Omicron. We're dealing with more potential inflation or rising inflation. And then to put all this on top, we also know that tapering is going to start happening from the Fed's perspective. And the overall monetary policymakers are basically saying, like, look, we're going to start to ease up on the buying. As we did in a previous video, this doesn't mean they're stopping. It literally means they're tapering. They're slowing down the buying of assets. But this is something to keep in mind because this can have an overall effect on the market as well and create some of that downward pressure where people or larger investors, firms, institutional investors, et cetera, are starting to make a move to cash or moving to cash in sort of a move to get ready to make a big play into what's interesting for them. And you may not be aware of what that is. So here's what we're looking for. Later this week, we're going to basically get this new release from the Labor Department. That's going to be our November Consumer Price Index. And this is going to be on Friday. So really have this in your mind all week. Excuse me. What we're going to be looking for, I don't know. I'm almost finding hard words nowadays or adjectives to use for for these things, but I'm going to read it out exactly as it was written from sort of the consensus of analysts here. So what we're expecting is November CPI should come in somewhere around a consensus of about a rise of 0.7% for November, month over month, compared to October's 0.9% rise. And this is going to be the 18th straight month of increasing CPI. Now, granted, if you were listening there, it was 0.7 October. I'm sorry, 0.7 for November, 0.9 in October. So it's still close enough, and there's some margin of error there where it almost feels the same for me. And then additionally, on a year-over-year basis, CPI is expected to accelerate to about 6.7% versus October's 6.2% annual raise. And I'm find myself repeating this more and more often, but this would actually mark the fastest increase since 1982. I'm not that old, but I wasn't born in 1982. And so to think that since before I was born, this will be the fastest rise or fastest increase, that's concerning. I mean, to put it frankly. And I think what I'm not hearing is I'm simply not hearing solutions. I'm not hearing anything coming out of the White House or the cabinet or frankly anyone about what they're trying to do to fix this. The planning that seems to be coming out as an investor or a trader here is not making me feel very good. It's making it very hard for me to decide where to put my money to work, whether I should take my hands out of the market, move some more to cash. And I talked to a lot of friends who are pretty serious level investors and traders, and they're sort of all taking a slightly different approach, but many of them are in cash. Some are in about 30% cash right now. Some are still sitting at about 0% because they're not concerned. They're so long term. Now, excluding certain pieces of CPI now, so things like food and energy as an example, we are expecting about a 4.9% year over year raise, up from the 4.6 from October. And again, now this once again on a year basis, excluding volatile food and oil, food and energy rather for that matter, this would be the fastest since 1991. These are a while ago, right? So we're seeing some crazy stuff happening here. So those are the numbers we're really expecting right now. I think that we are going to be having some pain for the near-term future here, and I think it's going to really pay dividends for all of us to think about where we're at risk in our market, in our portfolios, what that risk really looks like, and how easy it's going to be to withstand it. Now, at the end of the video, again, I'm going to be talking about the idea of tax loss harvesting, some considerations there, ways to think about it. And during times like these, I think this is where you can take advantage both of the timing of the year as well as the regulations that are in place to help you maybe take advantage of some of those losses that are sitting in your portfolio, both for stocks you may not want or positions for that matter, but also from the standpoint of being able to move into other things to take advantage of those losses. But anyways, again, I'll cover that towards the end of the call. So that's really the major piece I'm looking at from an economic indicator this week. There are, of course, always going to be other things. Non-farms are going to be coming out from productivity perspective. Mortgage applications will be out on Wednesday. Jobless claims on Thursday, right? But Friday, CPI, consumer price index, this is what I'm watching for. Inflation really does rule everything around me as an investor and professional trader. So I'm going to be paying close attention to this one. Now let's shift gears quickly to the earnings calendar. Not a crazy week, but I've got some fun ones in here. On Monday, we're looking at Coupa, MongoDB, GitLab, all after the market closes. Tuesday, we've got AutoZone before the market open. ChargePoint, Stitch Fix are both after the market closes. On Wednesday, we've got GameStop. We all know GameStop, I think, if you're watching a YouTube video. Rent the Runway are after the market closes. Now, on GameStop piece, frankly, I don't have any kind of positions in GameStop. I just really am interested to see what's going on here because I think it's going to be a true telling of a tale of how things can turn around when the market gets behind you and investors start to support you. And yes, maybe for one reason or another, people got into this for different reasons, but it's going to be funny to see the evolution of what's happened to GameStop since the entire sort of Wall Street Bets crowd took it on. Thursday, Broadcom, Chewy, Oracle, and Costco are all coming out after the market close. Now, Costco is one I'm particularly interested in of all of these that are coming out this week because Costco has really found a way to be pretty dominant. Now, I'm not currently in Costco. I don't have positions in it. I'm not even planning to take a position in Costco at this point. But I'm hearing a lot of talk around Costco really being able to move and start to make a play to take on some of the bigger players like a Walmart, like Amazon even, because their pricing model and their ability to have that bulk purchase might be something more and more people are starting to shift gears towards. So I don't have a ton of information to go on yet. I haven't really initiated my research on this one. Boy, I don't think he watches my channel, but I'll tell you what, Tom Nash, his style of looking at analyst reporting, the way he analyzes stocks, I'd love to see him pick up a Costco, sort of a non-traditional player, not the tech market, not that AI market, sort of your more retail-focused bulk retailer. I'd be curious to see what he thinks about this. So listen, if you're a famous YouTuber and you're watching this at this point in the video, let Tom know. It'd be awesome to see his take on Costco. Now, that sums up that piece of this video. So we talked about a few things, right? The falling knife and how this can affect our portfolios, both good or bad. We talked about CPI. We talked about some earnings. Now, if you've made it this far, and I really appreciate it if you have, what I really want to focus on for the moment is this idea of tax loss harvesting, because I think, number one, there's a couple of huge concerns I have for what I'm seeing just from a number of people that interact with our Facebook page, which is coming up on about 15,000 followers. So first of all, thank you to everyone who watches on Facebook. I really appreciate that. That's been huge. But the one most common question is, what do I do about taxes? And I'm like, oh my gosh, you guys, we're in December and we need to start really thinking about what this means and how it's going to affect our portfolios and frankly, what we owe. Because if you're all in the market, or even worse, if you're all in and on margin, you might have a tax bill to pay. And let me tell you, man, you want to pay the IRS when they come demanding for it. So let's just talk about this for a second. Whether you know this or not, anytime you take or recognize profits or losses, this needs to be reported on your yearly earnings when you do your tax returns. In the US, I'm talking specifically here. So full transparency, I don't know the law outside of the US. So if you haven't been looking or tracking this all year long, you should really take a second here and either go to like an hnrblock.com or turbotax.com and look for one of their calculators. Usually it's like a tax year 2021 calculator or something to that effect. And they'll let you actually enter some numbers in there. It'll give you a rough idea. And again, I'm not, of course, sponsored by either of those folks. I'm not saying you should use them to do your taxes. I'm not saying you shouldn't use them. But I do find that like calculators like that are really quick and easy ways to get a feel for if you're going to owe or not owe, or if you're going to get money back. If you think you've made some significant progress this year, you've taken profits, it's worthwhile to take a step back here and think about where you can start to get some advantage on that, depending on where your portfolio sits today after this big drop. So in its most basic format, the idea of tax loss harvesting is as simple as harvesting tax losses so you can offset gains and income to help lower your taxes. So for all those dividend investors, those LP investors, those MMP investors, if you've been taking profits on options or premium, or you've been selling puts in the market, anything that's generating gains or income, this is a great way to think about offsetting those gains at this time of the year. So here's a couple of really, really key things. Any losses you have in your portfolio can help you to reduce the taxes you'll owe by offsetting other gains in your portfolio, okay? And this is a key takeaway. Now, different types of asset classes, equities, currencies, real estate, etc., have different levels of benefit, disadvantage, advantage, different ways they're going to affect you. So that's why I'm saying it's really important if it gets complex to seek out a tax professional. And oftentimes, depending on the size of this, if we're talking a few $100, maybe you don't want to pay for a CPA. But if you're talking thousands of dollars or more, it's probably worth its weight in gold to talk to someone who can really help you do this. And even if you don't necessarily have gains right now in your portfolio, keep in mind, you can still take those losses now. They'll stay within sort of your reporting structure for taxes, and you can keep rolling those forward over time. And it doesn't just have to be against gains in your portfolio. If you just want to take losses to offset your actual income, this is a way to do that as well. Now, I'm going to clarify this point for a second. If you're sitting on more losses than gains in your portfolio, and don't worry, a lot of people are, you can also use up to $3,000 a year to offset ordinary income on your federal income taxes. And let's just say you lost $9,000 this year. Well, you can actually use $3,000 this year, $3,000 the next, $3,000 the next, according to the most recent regulations on this front. And again, speak to a professional. So the reason this is really important is we don't want to go into tax season not knowing where we stand on what we owe or where we could have made a difference in our portfolio. Now, if you're thinking to yourself, well, you know what, I'm in a really tough position on a certain stock or an ETF, but I'm going to hold it long term. Well, you may not have to, though, is the thing. It's not as simple as just saying, like, I'll just sit on these losses long term. Eventually, the price will go up or I'll dollar cost down. Well, there's other things you can do here, right? So what you can do is actually take that loss and either wait a certain amount of time before you get back into the position, and then you'll have no effect on what's called a wash sale. I'm going to talk about that in just a second. The other thing is you can actually transfer out of the loss that you're in and move into a similar but different enough position where you won't get caught up in this wash sale effect either. Now, here's the deal with a wash sale rule, right? So the wash sale rule states that your tax write-off will be disallowed if you buy the same security, a contract or option to buy the security, or a substantially identical security within 30 days before or after the date you sold the loss-generating investment. So But I'm going to say that actually one more time because this is a lot in there, but it's good to hear it again. So the wash sale rule states that your tax write-off will be disallowed if you buy the same security. So just take, for example, Amazon stock. If you buy Amazon stock, a contract or an option to buy or sell Amazon stock, or a substantially identical security as Amazon stock within 30 days before or after the date you sold the loss-generating investment. Now, people who receive stock or stock-like bonuses from their employer should also think about the fact that vesting date or employee stock purchase plan, otherwise typically known as an ESPP, purchase date may fall within that window. So make sure you know when that employee purchase is going to happen. So typically the way we think about this, and again, I'm really doubling down on this because I want to make sure you get help to do this the right way. Speak to someone who does this full time and knows the way to work within tax law, especially around investments. But the easiest way to think about avoiding a wash sale on an individual stock, while still keeping your money invested in that industry of the stock that you like, but even though you sold it at a loss, would be to consider switching out like a mutual fund, an ETF, some sort of a structured type of fund like that targets the same industry or has a large holding of that stock in it today. And even in all the material I've read, it's sort of very common to see this. Speak to a tax advisor. It's just the easiest thing in the world. And frankly, I bet you could probably call a lot of these places and they'll just give you a quick take on that as well. Now, here's really a great strategy to think about. It's important to think about tax loss harvesting in December, but you don't have to just do this in December. You can do it January through December. Anytime you have positions that have moved against you or in a way that could help your portfolio, take advantage of it. I know that a lot of the robo-advisors, like Betterment as an example, has tax loss harvesting built in. So they're doing this year round, looking for opportunities to switch sort of ETF A out for ETF A/B, right? Where it's sort of similar, sort of the same, but just slightly different. And that's an easy way to think about this. The key though, right, is make sure you're doing this in a way that's going to actually benefit you, not actually going to hurt you. And that's an important takeaway here as well. So with that, I have a final sort of question here that I want to ask for the audience. If you're still watching, I hope you are, but I also am going to be doing a lot of tax loss harvesting myself over the next couple of weeks. I've got some options that have moved too far against me, and I'm not going to carry them into next year. I've got some positions that I'm just not excited about, and I'd rather take out and move that money into something else. But one of the other things I'm also looking to do is, and I do this actually year round, I'm looking to donate some more money by the end of the year. So one of the ways we do this in my house all the time is actually, I just noticed I've got this cat behind me. This is my daughter's. This was one of the things during cleaning up the other day, where she wants me to donate this to someone who isn't going to get a toy. So Toys for Tots, things like that. But whether it's clothes, sporting goods, things around your house, think about people at this time of the year who could use the things you have and don't need. And you can also use that as a deduction on your taxes as well. Myself personally, we do give all year round. We're pretty consistent on our giving. We're pretty consistent on where and how we give, whether it's clothing, sports equipment, or just straight money to different funds. If you know of a specific fund that you think maybe doesn't have a lot of attention, I would welcome you to add it into the comments below if you think it's something worthwhile or something we should consider giving a donation to. I know we're going to be making several by the end of the year, and it's pretty significant amounts. So, if there's something that is really important to you or close to your heart, give us a little idea of why you think it makes sense. Maybe we can do something there as well. Of course, no promises. I'm not unlimited in what I can do here. But we do typically look at things like Alzheimer's, the Heart Foundations, different cancer things. We look at local food kitchens and pantries. We donate directly to our libraries. We look at our kids' schools. This is another strategy that, it's something that we take serious from a doing good perspective. We also want to make sure that, hey, there's a benefit to us from the way we earn and make our money as well. So with all that said, we talked about a lot, right? Here's what I hope you walked away with at the end of this video. We want to talk about falling knives and dollar cost averaging. We know that CPI is coming out this week. We've got some earnings and a couple of interesting ones I have my eyes on, like GameStop and Costco, as well as the ideas tax loss harvesting, wash sales, how to think about it, how to take advantage of it, and also the need to talk to tax professionals because they're usually worth their weight in gold. So with that, thank you so much. Hopefully you watch this. Hopefully you get value from it. And if you did make it this far, I really hope you did. Give me a suggestion of somewhere I should be looking at that might be a great place to donate some money. And if it makes sense, perhaps we can even do a video on it. So thanks so much. Thanks for watching. We'll see you soon. Have a good one.